Doing? I thought I would just do this video on YouTube because it's an easy way to chuck multiple really long video out, or really long. I'll try not to make it long, but I only get 5 minutes of Loom, and YouTube's free. So um, I figured I'd try and show you how I backtest um, with that London Open strategy you were talking about. So I've jotted down the rules here. Entry at the 10 a.m. candle, at the open of the 10 a.m. candle. So just to mark that out, this is UTC plus one. I've used an indicator which you can just put on, and that's just the 9 o'clock candle. So it obviously closes at 10 o'clock. So you'd be technically entering at the close of that candle. That indicator is called CM time-based lines. It's a bit of a faff to get it to the right time, but it's very handy for showing you. And then, as you talked about, um, stop loss 10 pips, TP 50 pips, indicator 20 EMA, and if it closes under the 20 EMA, enter a sell. If it closes above, enter a buy. I'll be honest, I've looked at where was it? I've looked at like a week, and the results weren't amazing. I think the 10 pips stop, in my opinion anyway, the 10 pip stop loss is a little bit tight. If you look at the ATR, so here the ATR is 27. Can't remember what that is on. That's set on 5. I put it to a 14, which is a bit more normal. So even then, ATR is 22. So that's kind of the average range of one of these candles moves, in this case, 18 and a half pips, 20 pips, 20 pips, shy of 18, 18.9, 14.5. So it's kind of showing you that actually a 10 pip stop loss is more than likely probably just going to stop you out, which in the majority of the cases it did. And I think there was only one trade, this one here, that hit 2.5 because it just went flying up. So it can work. Um, Personally, I'd probably think about making the stop loss bigger if you were going to move forwards with this idea. Um, the kind of options I thought of already, we use the ATR for a stop loss. Um, so one thing I've seen people do before is you just take the ATR and then you can put your entry there and um, use the ATR as your stop. You can add the ATR on from the low of the candle, for example. Does that make sense? Yeah, from the lower the candle or the higher the candle. Um, you can move your stop loss to covering highs and lows. So on this case, I'd potentially say it's a big candle, so you might want to just cover the low of that. You might want to cover this low here because we've had a slight pullback, then it's gone up, so you might want to cover the low. Um, Here, for example, I mean, this would be a losing trade anyway, but you might potentially just want to cover this obvious low. We've had a bit of a pullback, pushed up into London. Um, so you might want to cover that. It would make it a losing trade anyway, but kind of things like that. And then there's, of course, looking at structure on a bigger level. So you can see there we've had a few taps. So there was that stuff with highs and lows, and then there was a different entry model, which would be instead of just entering directly at the close of the candle, you put your entry like half a pip or a pip above the high. So you could keep your lowest stop loss potentially and say, I'm only taking a trade if it breaks out and breaks that level. So in this case, you wouldn't even get entered into a trade. You would take less trades this way, but the trade would it would have to go in your direction somewhat. This trade, again, that you would get taken into that trade eventually, but that will be about 3 o'clock. So you'd maybe have to set time parameters and say, I will set my entry 1 pip above the high of the 10 a of the 9 till 10 candle. And if it doesn't get tagged in within, I don't know, London session, which would be probably this one would tag you in, say by the close of this candle, if it didn't tag you in by then you wouldn't be in, you would just not take the trade. And in this case, I mean, if you put your 10 pip stop loss just above there, you could have hit a 5R pretty simply in that point. Um, and here, you'd have been tagged in, probably tagged in. If you'd put your entry above the high, you'd have been tagged in by this candle and taken out straight away. But, you're not going to win every trade anyway. So, and this one here again, if your entry is just below the low of the candle, you wouldn't have been tagged in and you wouldn't have lost because this one goes straight up and then it comes on down and you get tagged in on this candle and that would be a lovely win. So, I mean, it's definitely something to look into. It's a simple concept and just a few little tweaks like this, you could cipher out some pointless trades. I mean, then you could also add in, I don't know if it would work so much, but you could try and add in a structural component. So say like, actually, you're not going to take a long here because you can see that structure is still bearish, but you could maybe look on a higher time frame to give you some directional bias. Maybe look on the 4 hour or daily and say, oh, 4 hour properly, and say, all right, so we're in bearish phase. So I'm not taking a long trades here, which would again eliminate some trades, but you would get some trades which would have gone on to win and you'll miss some losers. So it's about kind of figuring out whether they all work together. There's a lot of things to think about really. But there's a lot of potential. I like little systems like this that are just pretty basic. Because because it's just such a simple idea, and then a few little tweaks can make it um, just much better. Even just that moving the entry, as I've just said, you can see here this trade you get a 5R, this trade you don't enter and lose, this trade you're going to get your 5R. This trade you would have probably been tagged in and that would have been lost, but over the case of 4 trades, which is nothing, I totally get that is nothing in the scheme of things. You'd have to test this over multiple years. Over the case of 4 trades, you've got a 50% win rate and 2 5Rs, and that's not even a trade, so you don't get a trade there and there. You get tagged in, but you take a loss. So you've made 10R, lost 1R, you've made 9R there. So that could be an interesting little tweak to it. So when I'm testing, especially if it's a basic strategy like this, you're just starting, put in all your ideas here and like say do, I don't even know, month, 2 months of, especially with this, because there's going to be a lot of trade. In the way you've given it, there would be a trade every single day, regardless of what's happening. So if you do a month, you're going to have 20 trades. You've made some notes of seeing stuff that's happening, and then you do another month, but say you adapt the entry for the next month and do that, and then maybe you can adapt the entry and maybe adapt the stop loss as well for the next month and see if that works better and kind of find what works better for you. For example, if here, if you decided to move your entry so it was underneath, but you also moved your stop loss to being, say, above the high, you're still going to get a 5R, but it would take a lot longer. It takes the whole day. And here you can see there is red news from America. And so you'd have to decide whether you're going to hold through that or sell off beforehand. You just, again, you need to, I have Forex Factory open as I'm going, so I can just check as I'm going, and then red news and such I would close out beforehand. Um, but moving your stop a bit bigger is obviously going to give you a higher win rate, potentially give you a higher win rate, but it would lower your risk to reward long term. Um, so there's just all of those to think about. But I've kind of adapted the sheet that I sent over to you, um, so that I've got it 1, 2, 5R, 2, 3, 4, 5R, but these are with moving the stop loss to break even at 1R to, to see if that helps overall profitably. Um, and then the same pair, day, date, time. I kind of was figuring I'd look at momentum as well, but it's not overly necessary. Um, I find it gets confusing if you were to do it, test it the same way 3 times, say like, well, this is what would happen if I did it the standard way, and then say you tested it and said, well, this was what would happen if I were to move the entry. Just do one type first, like the classic way that you talked about, and then do a month, see what the results are like, and then say do the next month with moving your entry, just so you don't confuse yourself. So that's all of that. And then I will jump onto my own sheet to show you what I do. So once I've compiled everything, so this is 2018 for EU. And you can see this is my monthly breakdown there. So if I look at, say, May, this is all the trades that I took in May. These are all ones that have equal highs. These are all ones that have news events around them. So if it's a zero, yeah. So I close early on news events. Um, and the red with stop loss extensions. But if I'm chucking all of them in there, let me just get rid of all of this crap. Um, so if I'm looking at May, the way I look at my data, I'll then chuck it in here. So I can see in May I had a 58.33% win rate, trading with my target as a 3R, moving my stop loss to break even when it hits 1R. But what I do prefer, so I have that for my win rate. Here, I also want my, so I have two sheets basically. One that just shows me my pure win rate, because that's the only bit of information that's relevant on here. And then one which includes taking off costs. So the win rate obviously shows as lower, but that's because things like this, that's a break even trade, but I would still have made a loss technically, because a break even trade isn't a break even trade because you would still have had to pay commission. So it shows my win rate lower, but technically I would still class my win rate as the 58 because I won 58% of my trades, and however many went to break even, two in this case. But it shows me, and the big thing here is it shows me in that month. So I've gone from 12.68% gain and 3.36% max drawdown to 11.9 and 3.66, which isn't too much. But once you start saying recording a whole year's worth of data, it's a lot. It's a lot more. And you can see there, so it's 11.9% for the year. So I do that for every year, and then every month I just record. I record 3.3R and 1.4R just because I like those as targets, and that's moving my stop loss to break even. And I like to have a monthly breakdown because it kind of gives me an idea of if I'm forward trading it further forward, it kind of gives me an idea of, I know I've got a 50% win rate, say, so you imagine you're going to be winning every month because whatever, but actually in this year, sorry, my average win rate is apparently 66%, which is, that's not because that is divided by 12. 55%. It's annoying, isn't it? Um, but I averagely make 2.36% per month. But looking through the data, you can see in January I made slight loss, February slight loss, March smashed it out of the park with a huge win, April slight loss, win, 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 slight loss, win, loss, loss, small win in December, um, which gives me around an average of 2.3% a month, which I mean, it doesn't sound a lot, 2.3% a month, but if you're trading 100 grand, that's 2 grand a month, or it's 2,300 a month, um, which, I'd be pretty happy with that. And obviously the aim is to get prop firm accounts of multiple hundreds of thousands. So if I could consistently make 2% a month and have a 55% win rate, I'd be absolutely buzzing. Once I've got all of my years completed, and I've filled in my monthly on all of them. I transfer everything over to the variation sheet. So that's just run from January to December. And then I do exactly the same thing again, um, but obviously with the full year. So for the full year there, I got a 54.5% win rate. Overall, it was like a um, 30% ROI on the year. However, when you're looking at, oh, sugar, when you're looking at the ROI, especially in these sheets, it's not overly relevant because that's showing you how your year finished. It's not showing you how your year went. And also it's backtesting data. So realistically, it's, it's not going to happen exactly the same in the future. This is where the Monte Carlo simulator comes um, into effect. So, for example, with this set of data, I'm going to get my months as well because it just helps me. With this set of data, once I've put in my costs, with a 1.4R target, moving stop loss to break even, that gives me a 30% gain on the year, and I always risk at 1%. I don't necessarily do that trading, but that's how I test. So I've always got consistent results. Um, and that you can see there, it's given me a 9.82% drawdown. So I would not have lost a prop firm account in this year, and it would have been pretty sweet. But you can see here, you've got the account cash, gain, and drawdown. And the drawdown, however, is from all-time highs. So here you can see we've gone up to £103,307. So I'm up 3% on the account. Lose a trade, and it says I'm in 1% drawdown, which I am in 1% drawdown. But if you're in a prop account, you're not in drawdown now. You're in profit. So I may never have gone, yeah. So that's telling me I'm in drawdown and my max drawdown is 9%. However, if this were a prop account, then I would never have got into drawdown after, if I just traded and not taken any profits out, I would never have actually gone into drawdown or under the 100 grand that they give you. But what I like doing as well, and this is purely speculation and it probably would never happen as nicely, but I like looking down my gain loss until I hit my 10% because that would be target one on a prop firm account is the 19th of April. So it would have taken me till middle of April to hit 10%, which is 4 months of trading to hit phase one of a prop account. And then if I take that, I'll drop that in here. So this would have been, so say that's me. I've passed phase one. I've had to start again on phase two. So this is me trading phase two. I've immediately gone into 3% drawdown, faffing around in drawdown for what's that, April, May, just jump out of drawdown at the start of May. And then you've got to hit 5%, which there happens on the 22nd of the 6th. So it's taken me 3 months. So 2 months then to pass phase two, which would be pretty sweet. So it's basically taken 6 months to get a proper count in this year. And I did pick a very good year for this strategy just because it's easier to show. And then for the rest of that year, you can see this would have been your live account. Um, and you can see that you can jump out there. So there you're up like 2%. Probably want to take some money out there, take some returns out. Um, so say you'd taken money out at that point, you're taken a withdrawal at that point of all of the money you've got available. So you start again with a fresh 100 grand account, and then boom, oh look, you hit 3% in like three trades. So you stop trading, take a withdrawal. You've made like, and then this is the middle of July, and you've had nearly 4 to 5% of returns already. So you've made like 4 grand already just by being patient and trading the start of the year, the 6 months of the year. And at the same time, you could have started a second challenge as soon as you'd passed your first one, and you'd be doing pretty happily. So that's what I do with all my data, and that's just play. This bit's kind of just playing around, kind of feeding ego and saying like, oh, I can be funded in 6 months. Might happen, it might not happen. But once I've done each year, I then record it into another spreadsheet. So I just take the full year's data, pop it in a spreadsheet, put a little graph up of my results. So that's 2017, which is lovely. 2018, which is lovely. 2019, absolutely ghastly. I think I mean, it closes at about 25%. On this is actually a different, that's the wrong graph, but it's a minor, you lose 15% in this year. It's just not a good year for the strategy. Don't know why. It just doesn't work. The next year you make it up. Um, Following year it's pretty poor again, but you'd come out making profit still. Just about. You make a 4% profit there. 2022 again about 13%. But then for the variations, I add every year into here, which gives me a total of 1,322 trades over the 7.5 years, because it's only got half of 2024. And then I do exactly the same thing of taking all of the data, pop a little graph on so you can see that here is 2019, this massive um, drawdown, and then it kind of just kicks into gear and slowly just works after that. I actually ended up looking through my data a lot more and getting rid of some entries that didn't work as well, um, because that's what all these notes are and such, so I could change them later. So my final data came to the 50%, 50.8% win rate, and that was over just shy of 900 trades. So I'm happy with the sample size. Drawdown's a little bit less here, and then it moves up at a lovely pace. Um, I mean, people would look at this and say that's, you know, it's not going to make you a millionaire overnight, and it's not. But it's kind of consistent, and I've got a really good sample size, in my opinion. I've got a good sample size there, a decent amount, and I wouldn't be trading this alone. I think I've showed you already, but I would be trading mixed with my second strategy, which is the opening range breakout. Um, and then you can see I've kind of put all of the trades together from 2017 onwards, win rates just shy of 51%. Drawdown in that period was about 19%. You can see, though, straight from looking at the chart, there is a pretty stagnant period here of quite a few trades, but you don't really lose that much in the scheme of things. And then when I pop down to my breakdowns of year on year, you can see there that 2017 you're making 34R, then 20R, then 19R. And if you remember 2019 on this here was a 15% or minus 16R. So by mixing it, and I've not adapted my strategy to over optimize, I've just added in a different strategy that is different enough that they just work for each other. The actually the biggest one, which was annoying, is that you can see here 2022, this strategy works fine. And then obviously the other strategy must have been having a bad year because you pretty much come out at break even for the year. But you know, whatever. I mean, averagely there over the 7 years, you're making about 30%, 30R a year. So that's whatever you're risking. If you're risking 1%, that would be 30%. If you're risking 0.5%, that would be 15%. And it depends how you trade it and what you're trading on. If you're trading on a prop firm, if you're trading a personal account, if you're trading with Darwin X or whatever. But that's kind of how I've pushed all my data together, chuck it into a line graph so I kind of get a visual representation. And I like these year on year breakdowns because it gives me a bit of a idea of what to expect with a year on year trade. So I think that should pretty much cover everything I do with backtesting, with how I move my data around just to within the spreadsheet. And then the only other thing I suppose was the Monte Carlo simulator, which moved out of my way. You bugger off there, Robert. Can we see one that says trading? There we go. Oh my God. You can see I don't even look at half of these things. If we can see one that says Monte Carlo, I have trouble finding this every bloody time I want it. But I'm sure it's somewhere at the, oh, that's the one, equity curve simulator. So that is what I use for an equity curve. So if I say I put in 10,000 as a starting rate, I've got a 50% win rate. I'll leave it at that. And so it is 51 technically, but I'd always under thingy, and then it's 1.5 to 1.6. So I put that as 1.5 with a not 11.5. That would be an amazing rate. Let's put 1,000 in, and then number of lines 100. So that's basically the same as my back testing data there. I'm starting with 100 grand. Probability is 50%. I'm underestimating slightly. And my win to risk to reward is averaged out at 1.5. Start simulation, and that kind of this simulates these statistics. It shows me 1,000 to over 1,000 trades, and it shows me what could happen 100 times out of 1,000 trades, and then it gives me my biggest max drawdown, which is over these 100. Well, technically, it's over the 10,000, 100,000 trades. Over all of these 100 lines, each of these is 1,000 trades, and the biggest drawdown out of the 100 lines and 100,000 trades was 24%. The average drawdown, which is obviously just all of the drawdowns divided by whatever it is 13.6. And then that shows me my average winners and losers. And I just do this a couple of times to kind of see, you know, does it there jumped up to like 30% now, just to show that, you know, it does happen. But actually, at the same time, all of those lines are amazing. Even if you just caught this bottom one, you would still be in profit after 1,000 trades, which would take about 3.5 years. But um, the average, the big black line there, is your average. So if you started with 10 grand in 7 years, 3.5 years trading what I did, the average outcome would be around there. You'd have turned your 10 grand into 125 grand. You know, it's all pipe dreams unless you're, I don't know, is it? We'll see in 3.5 years how I'm doing. Um, but yeah, that's the equity curve simulator that I use anyway. So that is probably long enough. I think that covers all the back testing that I do, the way I kind of move my data around to look at it. And yeah, I'm going to be over the next couple of weeks, I'm going to start doing some scripting. So I might try and I might use my first trial, might be scripting that GU system. Okie dokie. I'll speak to you later. Bye.